There is a specific kind of investor who shows up in personal finance communities that nobody really talks about directly. Not because they are hiding, but because their situation is so different from the average person's situation that most financial content simply was not built for them. They earn well. They have already maxed out their Roth IRA. They have already maxed out their 401k. They have a taxable brokerage account that is growing every single month. And every time a new video comes out saying buy SCHD for dividends or buy VOO and chill, they nod politely because the logic is sound, but the strategy is incomplete for where they are in life. They are not trying to figure out how to invest $500 a month. They are trying to figure out what to do with $40,000. Meet Marcus. He is 38 years old. He runs a successful logistics business that he built over 12 years. His net worth is around $2.1 million, spread across real estate, retirement accounts, and a taxable brokerage that he has been aggressively building for the past 3 years. After taxes, business reinvestment, and living expenses, he has been able to deploy roughly $40,000 per month into the market. And when Marcus first started investing seriously, he did exactly what every YouTube channel told him to do. He bought VOO. He bought SCHD. He felt disciplined. He felt smart. He felt like he had a plan. But 2 years in, Marcus started asking a question that the standard advice had not prepared him for. He was not chasing hot stocks. He was not trying to time the market. He was not asking how to get rich quick. He was asking something deeper. Given that I have the income, the time horizon, and the emotional discipline to invest seriously for the next 25 years, is a portfolio of just VOO and SCHD actually the most intelligent long-term strategy available to me? Or am I leaving significant return potential on the table because I have built my entire portfolio around what is easiest to understand rather than what the evidence most strongly supports? The honest answer to that question, backed by decades of academic research and increasingly supported by real-world fund performance, is that the standard VOO and SCHD combination, while excellent and far better than most alternatives, is not the complete picture. It misses exposure to several factors that decades of financial research have shown to produce premium returns over long time horizons. It has significant concentration in U.S. large-cap growth stocks, which have dominated performance for the past 15 years, but which carry valuation risks that a truly sophisticated long-term investor should take seriously. And it misses an entire universe of international exposure that the world's most respected institutional investors consistently argue belongs in any serious long-term portfolio. So let's build Marcus's actual portfolio, piece by piece, with the logic behind every decision made explicit. The foundation of Marcus's portfolio starts where everyone starts: broad U.S. market exposure. But instead of VOO, which tracks only the S&P 500's 500 largest companies, Marcus uses VTI, the Vanguard Total Stock Market ETF. The difference matters more than it sounds. VOO gives you the 500 largest U.S. companies. VTI gives you over 3,700 U.S. companies, including those same 500-plus mid-cap and small-cap companies that are excluded from the S&P 500. Over long time horizons, smaller companies have historically delivered higher returns than large companies, a phenomenon so well documented that Nobel Prize-winning economist Eugene Fama and his research partner Kenneth French dedicated much of their academic careers to studying it. The size premium, as it is known, means that a portfolio, including small and mid-cap exposure through VTI, has a higher expected return ceiling than one limited to S&P 500 names. VTI charges just 0.03% annually, delivering the broadest possible U.S. market exposure at the lowest possible cost. Marcus puts 25% of his $40,000 monthly, which is $10,000, into VTI automatically on the first of every month. No analysis required, no market timing, just consistent ownership of the entire American economy. But here is where Marcus's portfolio immediately diverges from the standard template. His second position is not SCHD. It is QQQM, the Invesco Nasdaq 100 ETF, which is the lower-cost, retail-friendly version of QQQ. QQQM holds the 100 largest non-financial companies on the NASDAQ, meaning it is heavily concentrated in technology, artificial intelligence, and the most innovative growth companies in the world. Its expense ratio is 0.15%, lower than QQQ's 0.20%. Its 10-year annualized return has been approximately 20%, nearly doubling the broader market over that period. Marcus's reasoning for including QQQM is specific and worth understanding in detail. He is 38 years old. He has a 25 to 30-year investment horizon before he needs to draw on this money meaningfully. Over that time horizon, the companies driving the AI revolution, the cloud computing transformation, the autonomous vehicle transition, and the next several waves of technological disruption are disproportionately represented in the NASDAQ 100. He is not chasing a trend. He is acknowledging that technology is not a sector, the way energy or utilities are sectors. It is the operating system of the modern economy, and QQQM gives him ownership of the companies most deeply embedded in that operating system at a cost that is near negligible relative to its potential contribution to long-term wealth. Marcus puts $8,000 per month into QQQM. Now we get to the part of Marcus's portfolio that most casual investors have never heard of, and which represents the single most intellectually interesting decision in his entire strategy. His third position is AVUV, the Avanti's U.S. Small Cap Value ETF. If you have spent time in advanced personal finance communities, you have probably seen this fund mentioned. If you haven't, let me explain why it is there and why it represents one of the most compelling investment cases in the entire ETF universe right now. The academic foundation for AVUV comes directly from the FAMA French three-factor model, which identified three specific characteristics that predict higher expected returns over long periods: market risk, which is exposure to stocks over bonds; size, which is owning small companies rather than large ones; and value, which is owning cheap companies by fundamental measures rather than expensive growth companies. A company that is both small and cheap, meaning low price relative to its earnings, book value, and cash flow, has historically delivered meaningfully higher returns than the broad market over sufficiently long time horizons. This is not a theory. It is one of the most thoroughly tested and replicated findings in all of financial economics, documented across multiple countries and multiple decades of data. AVUV is an actively managed fund run by Avanti's Investors, a firm founded by Eduardo Repetto and several colleagues who came from Dimensional Fund Advisors, the company that Eugene Fama himself worked with and that has been putting factor investing into practice for decades. Unlike a pure passive index fund, AVUV uses current price and profitability information to tilt its portfolio more aggressively toward the small cap value factor than a traditional index can. It holds approximately 777 small U.S. companies screened for low valuations and strong profitability. Its portfolio turnover rate is just 4%, making it extraordinarily tax-efficient despite being actively managed. And its performance record since inception in 2019 is remarkable. A cumulative return of 85.62% from January 2020 to July 2025, ranking first among all small-cap value ETFs tracked in that period. But here is what makes AVUV particularly compelling right now, in February of 2026. The valuation spread between growth and value stocks in the United States is currently at what Seeking Alpha's quantitative analyst described in December 2025 as a 100-year extreme. The gap between how expensive the most popular growth stocks are relative to their earnings compared to how cheap small-cap value stocks are relative to their earnings is wider than it has been at almost any point in modern market history. The last time the valuation gap was this extreme was the late 1990s dot-com bubble. After that bubble popped, small-cap value stocks outperformed large-cap growth stocks by massive margins for an entire decade. Mean reversion in financial markets is not guaranteed in any given year, but over a 25-year horizon, buying assets that are historically cheap relative to their fundamentals is one of the most evidence-backed strategies available. Marcus puts $7,000 per month into AVUV. He expects it to be volatile. He expects years where it significantly underperforms VOO and QQQ. He holds it anyway because the expected return premium is real and because his time horizon is long enough for that premium to express itself. His fourth position is VTV, the Vanguard Value ETF, and it serves a specific purpose in the portfolio that AVUV cannot fully serve on its own. While AVUV gives Marcus concentrated small-cap value exposure, VTV gives him large-cap value exposure. VTV holds 315 of the largest undervalued companies in the U.S. market, with an expense ratio of just 0.04%, and an average annual return since inception in 2004 of 9.09%. Its top holdings include Berkshire Hathaway, JP Morgan Chase, ExxonMobil, Johnson & Johnson, and Procter & Gamble. These are not exciting companies. They are dominant, deeply profitable, and in most cases, trading at significantly lower valuations than the tech giants that dominate VOO and QQQ. The reason to own both AVUV and VTV alongside VTI and QQQM is factor diversification. Marcus's VTI holding gives him the total market. His QQQM holding gives him growth factor exposure. His AVUV holding gives him small cap value factor exposure. His VTV holding gives him large cap value factor exposure. Together, these four domestic positions give him ownership of the entire U.S. equity market with a deliberate tilt toward factors that academic research most consistently associates with higher long-term expected returns. He is not trying to time when value beats growth or when small caps beat large caps. He owns all of them systematically, in proportions calibrated to their evidence-backed expected return premiums. Marcus puts $6,000 per month into VTV. His fifth position takes the portfolio global in a way that most American investors dramatically underweight. Marcus puts $5,000 per month into IFA, the iShares Core MSCI EF ETF, which provides exposure to approximately 2,600 companies in developed international markets, including Europe, Australia, Japan, and other developed economies outside North America. IFA charges just 0.07% in annual fees. Its trailing 12-month dividend yield as of early 2026 is 2.9%, meaningfully above the domestic funds in the portfolio. And the investment case for holding it is the same one that BlackRock, JP Morgan, Vanguard, and Schwab have all made repeatedly in their 2026 Outlook publications. International stocks are significantly cheaper than U.S. stocks on virtually every valuation metric, and the period of U.S. outperformance that has dominated the past decade is historically unusual in its duration and magnitude. The MSCI EF index is currently trading at a price-to-earnings ratio approximately 35% below the U.S. market. That valuation discount reflects genuine risks, including slower economic growth in Europe and demographic challenges in Japan. But it also creates the conditions for outperformance. In the year-to-date through February 2026, IFA is already up 11.4% compared to VTI's 0.41%, an early vindication of the international allocation thesis that Marcus built into his portfolio before the trend became obvious. An American investor who owns only U.S. stocks is making an implicit bet that the United States will continue to outperform every other major economy in the world for their entire investment lifetime. Marcus is not willing to make that bet in concentration. IFA ensures that wherever global economic leadership resides over the next 25 years, his portfolio participates in it. His sixth position is AVDV, the Avantis International Small Cap Value ETF, which applies the same small cap value factor tilting that AVUV applies to U.S. stocks, but to international markets. AVDV holds over 1,300 small international companies screened for low valuations and high profitability. It charges 0.36% in annual fees, higher than most of the other funds in the portfolio, but still modest for the exposure it provides. The logic for including it alongside IFA mirrors the logic for including AVUV alongside VTI. The size and value premiums have been documented internationally as well as domestically, and international small-cap value stocks are currently trading at valuations so compressed that the long-term expected return premium is particularly elevated. Marcus puts $2,000 per month into AVDV, making it the smallest position in the portfolio, but one he intends to grow over time as conviction builds. His seventh and final position, receiving $2,000 per month, is TIPS, specifically the iShares TIPS Bond ETF, ticker TIP. Treasury inflation-protected securities are U.S. government bonds whose principal value adjusts automatically with inflation. They are not a growth asset. They are a real purchasing power protection asset. Marcus includes them not because he expects them to drive returns, but because of the role they play in a high net worth portfolio that he will eventually need to draw from. As his taxable brokerage account grows from its current level toward a figure that could realistically fund decades of retirement spending, having some allocation to real assets that protect against inflation scenarios provides genuine insurance against the one macroeconomic risk that can permanently destroy retirement portfolios: sustained inflation that erodes the real value of every nominal asset in the portfolio simultaneously. TIP ensures that Marcus's portfolio has at least some explicit protection against that scenario at a cost so low that it does not meaningfully drag on overall returns. So where does that leave Marcus's $40,000 per month? $10,000 into VTI, $8,000 into QQQM, $7,000 into AVUV, $6,000 into VTV, $5,000 into IEFA, $2,000 into AVDV, $2,000 into TIP. His blended expense ratio across the entire portfolio is approximately 0.08%, which means on a $40,000 monthly investment, he is paying roughly $32 per month in fund fees. For that $32, he gets exposure to approximately 12,000 companies operating in virtually every country and every sector of the global economy, with deliberate factor tilts toward the characteristics that academic research most consistently associates with long-term outperformance. At $40,000 per month, Marcus is investing $480,000 per year. At a conservative blended annual return of 9%, which is below the historical performance of most of the individual funds in his portfolio, his investment after 20 years will be worth approximately $27 million. At 10%, it will be worth approximately $33 million. These are not lottery ticket projections. They are what compound interest does when given enough capital, enough time, and enough discipline to not be interrupted by fear, greed, or the constant noise of financial media telling you to change your strategy every quarter. The real lesson of Marcus's portfolio is not any specific fund. It is the framework behind the fund selection. Start with the broadest possible market exposure. Add deliberate tilts toward factors with evidence-backed return premiums, size, value, profitability. Include international exposure to avoid the implicit concentration bet of a U.S.-only portfolio. Keep costs ruthlessly low. Maintain the same positions through every market cycle, regardless of short-term performance. And never confuse familiarity with optimality. VOO and SCHD are not inferior funds. They are excellent funds. But for an investor with Marcus's time horizon, capital, and sophistication, they are the floor of the strategy, not the ceiling. The ceiling is built by understanding factor investing, international diversification, and the difference between the portfolio that is easiest to explain at a dinner party and the portfolio that the academic literature most strongly supports over a 25-year horizon. Most people will never have $40,000 a month to invest. But the principles behind Marcus's portfolio work at $400 a month too. The factor tilts are the same. The international diversification is the same. The low-cost discipline is the same. The only difference is the scale. And the scale, ultimately, is just a function of the income and the discipline to keep showing up every single month in bull markets and bear markets alike, without asking whether now is a good time. Because for a long-term investor, the answer to that question is always the same. The best time to invest is always as soon as you have money to invest.